Hello. On behalf of NACD, welcome to today's webinar, Implications of the SVB Collapse for all board members. My name is Marcel Buchescu. I'm the Senior Director of Credentialing and Strategic Engagement here at NACD, and I'm delighted to have you with us for what should be a lively discussion. Before we get started, a couple of quick housekeeping items. First, today's webinar is being recorded, and the link will be shared after the event. Second, we have a poll that I'm going to open now. We'd like to ask you to answer the question to get a sense of the type of boards that are represented on this webinar. I'm going to leave this open for the next few minutes. You can select all the boards that apply. Attendees for this live webinar will receive 1 NACD credit towards their NACD Directorship Certification and Board Leadership Fellowship maintenance requirements. To learn more about NACD's credentialing programs, including Directorship Certification, please visit nacdonline.org. There are lots of discussions and perspectives on the topic that we're going to cover today. I imagine many of you have spent hours on the phone reading the news articles, blogs, perusing social media on this. So clearly a significant event, and and certainly the number of participants on this webinar is an indication of that. With that context, it is still a very fast-moving situation. We're learning more all the time. There's a great deal at this point that we don't know, and we just want to be mindful of it on this webinar. With this webinar, we're trying to create some space for some real-time thoughts and perspectives and thinking on this. Our speakers do not have any inside knowledge of the events, though, as they will disclose, there may be business interests and other relationships. Our intent here is not to speculate or assign blame or responsibility. Plenty of other people will do that. So we're going to stay away from those parts of this conversation. What we do want to do today is to reflect on what transpired and consider what boards and directors might take away from this in real time and moving forward. With that in mind, our speakers have agreed to come on and share their thoughts, and I want to express my appreciation to them for doing that and spending the time with us today. We encourage your questions throughout, and we have time built in towards the end of this webinar to address them. And thanks to those that submitted questions and comments in advance as well. During our session, you can submit questions through the Q&A feature in Zoom, and we'll bring them into the discussion at the appropriate time. I also want to be sure to recognize the work of the NACD chapters throughout all of this, and in particular, the NACD Northern California chapter and their executive director, Lisa Spivey, for helping us bring this webinar together and introducing us to Christine and Louis in particular. And with that, I'd like to introduce today's moderator, Jane Sadowski. Jane is an experienced director serving or having served on public, quasi-governmental, PE-backed and nonprofit boards. She spent a 25-year career as an investment banker specializing in mergers and acquisitions, and currently serves as a senior advisor in human capital management at Moelis & Co., where she focuses on DE&I curriculum and coaching. Jane is an NACD Board Leadership Fellow and is NACD Directorship Certified. And Jane has also just joined the board of the New York chapter of the NACD. Jane, thanks for your help in leading today's discussion. I'm going to turn it over to you.
Thank you very much, Marcel, and thank all of you who are attending today. I know that there have been a lot of these webinars. We hope that this one can give you specific context for board members in these situations. So before I introduce our esteemed panelists, let me just give some preparatory remarks. For the bank and the industry that's come to define Silicon Valley, the awareness of the events leading up to the seizure of Silicon Valley Bank and later Signature Bank on Friday is global, and the repercussions will take a long time to play out. So we are really talking about something right in the middle of it. I'm delighted to introduce our NACD panel, who will help us all make sense out of what has transpired and provide actionable takeaways for board members across geographies, across company constructs, and across industries. Louis Lehot is a highly experienced corporate and securities attorney who focuses on advising public and emerging private companies, as well as their venture capital and private equity investors. He's a partner at Foley and Lardner, based in the firm's Silicon Valley, San Francisco, and Los Angeles office. Gary Zimmerman is the managing partner of Six Trees Capital and the founder of MaxMyInterest.com. Previously, he was an investment banker at Citigroup, where he was a managing director and global head of strategic solutions for sovereign wealth funds, responsible for advising these funds on their direct investments globally. Christine Gorjan is an experienced, did I get that right, Christine? is an experienced public company CFO, board member, and advisor, primarily with multinational high-tech, biotech, and healthcare companies. She currently serves on the boards of Carbon Health, Juniper Networks, and Invitae. Her CFO experience includes Arlo Technologies and Netgear. Prior to moving to the corporate side, Christine spent 8 years in public accounting. So we have a lot of bases covered for what board members ought to know. In framing the discussion, we considered with Marcel and each other lessons for board members. We felt a little bit like Angelica Schuyler in Hamilton, in that we came upon 3 fundamental truths at the exact same time. 1, there were many points of failure leading up to the demise of Silicon Valley Bank. 2, we have an opportunity to look at whether and what governance changes might be considered for the VC and private company ecosystem moving forward. And 3, all companies, not just companies in the Valley, not just tech companies, not just venture capital companies, will feel the repercussions of these events. Taking on fundamental truth number 1, many points of failure, I'd like to turn to Louis. Louis, can you please give us a brief overview of what happened with Silicon Valley Bank? Did it just start last week? What were the core causes?
Jane, thank you so much to you and Marcel for having me. A quick disclaimer, the information I'm going to present is not legal advice and does not create an attorney-client relationship. I'm delighted to answer questions, but please understand that any answers will necessarily be general in nature and cannot be tailored to your particular situation. I want to remind everybody this is an open public meeting, so no one should share any confidential information. I also need to disclose that both Silicon Valley Bank and Signature New York Bank are unsurprisingly clients of Foley and Lardner in unrelated matters, and any information I share about them is from public sources and is not confidential. These are my views and may not necessarily reflect the views of my partners and colleagues, although we do tend to agree on most things. And finally, these are rapidly evolving events, and the information I may share could become out of date very quickly and without notice. Okay, housekeeping aside, Jane, I work at a law firm with 1,200 lawyers in 25 cities around the country, and my team is in Silicon Valley. We're about 45 lawyers supporting hundreds of technology companies, many of whom bank at Silicon Valley Bank and Signature Bank and some of the other regional banks that serve the market here. And the relationships that they have are so intertwined. And I know that that's one of the themes that you're going to talk about. So coming back to your question, when my phone rang at 6 in the morning on Thursday with the special ring from one of my CEO clients in something of a panic, it put me in a panic. And at a very high level, what happened was that I believe it was over a year ago, as Silicon Valley Bank was receiving a historic amount of new deposits from venture capitalists and companies who were funded by venture capitalists during the venture capital boom. They bought a whole bunch of 10-year treasury bills without making provisions for the possibility that rates might go up quickly, dramatically lowering the value of those bonds. Meanwhile, venture capital funding activity went down, which meant that startups who bank with SVB began to use up their cash. And that meant that bank experienced lower cash reserves than they had expected, and they were forced to sell some of those bonds at a loss. And I believe that a week ago today, they announced a $1.8 billion loss. Word got out, and there was just an old-fashioned run on the bank, cue Jimmy Stewart. So Thursday morning, venture capital firms sent emails to their portfolio companies suggesting that they withdraw their funds from SVB just in case. A very prominent Sand Hill Road VC firm used a WhatsApp group with 1,000 startup founders to broadcast a warning for everyone to take their money out of SVB accounts. And the run on the bank turned into an all-out rout. And by the end of the day, the bank was insolvent, and the Federal Deposit Insurance Corporation set up a receivership and took over the bank. Overnight, a new bank was formed called the National Bank of Santa Clara, which is today operating as Silicon Valley Bridge Bank, and it's operated by the FDIC with all of the assets of the former Silicon Valley Bank. And it happened with stunning speed, Jane. Then on Monday, depositors, we then spent Friday and the weekend wondering how we were going to make payroll, as most of our funds were only insured up to $250,000. And Jane, what I found surprising as Thursday and Friday went on was to find that some of my early stage clients, it didn't surprise me that all of their funds were at one bank, Silicon Valley Bank. But as the day wore on and I got panicked phone calls from people with an excess of 100 and in one case $400 million in one account, I realized the gravity of the problem, Jane. That if $400 million went up in smoke, the impact that was going to have on the employees of that specific company, of the venture capital fund that had funded that company, and all of the supply chain and value chain that supported that company, and in fact, the entire technology ecosystem. And so really, Jane, that is the specter of the problem. So through the weekend.
Let me
Yep.
stop you there, and thank you very much for those insights. One of the great quotes I read about this, and you mentioned being panicked on Thursday morning, is somebody said, if you're going to panic first, which I think leads into your run on the banks. I'd like to, if I may, turn this to Gary. As I recall, when Enron was collapsing, one of the things that came out of that was that they were funding the construction of their headquarters building with commercial paper, thus breaking the cardinal rule of funding long-term assets with short-term financing. Is there an analogy here to Silicon Valley Bank? And can you elaborate, please, on the specific financial risks that venture capital and portfolio companies either mispriced or assumed away?
Well, thank you, Jane. And I think, first of all, it's a pleasure to be here. I think Louis got it right in the sense that Silicon Valley Bank's business model had two inherent risks in it. And these are risks that are applicable, frankly, to all businesses. This is not specific to banks. And those risks were concentration and correlation. So their concentration risk is that they banked a niche in the industry, which happened to be Silicon Valley, and that little niche turned into a much bigger niche in a zero interest rate environment when many tens of billions, hundreds of billions of new capital flowed into startups. And so, Silicon Valley, if you go back to the 80s, was a pretty small clubby world. Now it's a very large clubby world, but it's still very clubby. And because all of those businesses know one another so well, a single, posting on WhatsApp can lead to pretty significant consequences. So concentration risk in terms of not just the interconnected nature of the depositors and the borrowers, but also the fact that almost all of these loans were going to tech startups, tech and healthcare startups. And that then ties into, and there's concentration risk as well, in the sense that their deposits in almost every case were far in excess of the FDIC limit, which if you think about a bank run as being sort of like a forest fire, where you've got a lot of tall trees standing next to one another, that concentration risk really made for a forest where the tinder was dry. And what was needed was the spark, and that spark was the loss on unavailable for sale securities, which was a risk that was well known as well. I was at a Piper Sandler conference maybe 4 or 5 months ago, where there was more than an hour of discussion on the risks inherent in mark-to-market unavailable for sale securities, which was sort of the spark in this forest fire. The other risk, though, beyond concentration, was correlation. And this is the one that Louis touched on, which is, in Silicon Valley, it's a very boom and bust industry, much like the energy industry. And good times feel really good and bad times feel really bad. And so in good times, they were underwriting a lot of new loans and they were taking in a lot of new deposits from other portfolio companies. In bad times, the correlation risk here is that at precisely the moment when some of those startups might be defaulting on their loans, that would correlate highly with the moment in time where there were very few new venture financings. And so that was sort of the inherent risk in SVB's business model. And unfortunately, it all came crashing down pretty precipitously.
Thank you. So I think we have our takeaways. Number one, make sure your companies are not funding long-term assets with short-term financing, particularly in an increasing interest rate environment. And number two, ask about concentration risk and or correlation risk. Staying with you, Gary, what about affinity risk? That is the thought that if all the smart VCs and all of their portfolio companies have all their cash at Silicon Valley Bank, it must be safe.
Well, I mean, I think that's a case of people not doing their homework, right? It's very easy to say, well, my friend does it this way, so I should do it that way as well. But I think it really behooves each of us to do our own homework. Everyone has to read the fine print. My wife often teases me that, whenever we close on a mortgage, I sit there in the room and I read every document for an hour. And apparently no one else does that. And, maybe that's a little embarrassing, but, I think if you're going to sign something, you need to know what you're signing. And I think the reality is that in Silicon Valley, the VCs knew that they were taking this unsecured creditor risk. The companies, however, might not have known it because most company founders are relatively young, relatively inexperienced, and relatively powerless. And so if your VC or your board member tells you to do something, a lot of them don't question it, they just do it. And so there is a little bit of a lemming mentality. And that, that can apply to the companies, it could apply to the VCs. One of the analogies that I was thinking of recently was that of a flash mob, right? When we think about a bank run in these days of social media, a flash mob can emerge and destroy a bank very quickly. And this, again, isn't just an issue for bankers. I know in the retail sector, there's been a lot of shrinkage because of flash mobs that can appear at a store, and the store is equipped for a certain volume of traffic, but they're not equipped for 1,000 people descending on a store at one given moment. So I think these are risks that extend far beyond the banking industry. They may be relatively remote risks, but a prudent part of risk management is identifying the risks that you can see and trying to identify the risks that you can't see, and then deciding across a risk matrix which risks are likely and which are unlikely, and what are the consequences of those risks. Because you may have something like the SVB situation where the risk was very low, but the consequence is dire. And then there are other risks where the risk is high, but the consequence of someone stealing a tube of toothpaste is probably not going to bankrupt your company.
So thank you very much for that. I love the analogy of the flash mob. Louis used the term old-fashioned bank run, and that was used a lot in the media. And they had lines of people outside brick and mortar banks, but $42 billion was removed from the bank in one day. That's a very long line. I think that, again, takeaway number 3 here is control of your narrative is no longer assured. When social media gets involved, the game becomes one of quick fingers and who's got the most followers, and that can dominate your news cycle. It can also dominate what happened here at Silicon Valley Bank. So thank you for that. Christine, I think Silicon Valley Bank revealed in a 2023 proxy statement that its chief risk officer left the company in October, but had stopped performing the role in April. The company had someone take over that role in December. The new CRO is based in New York versus all the other C-suite people being based across the country from New York. In your experience, could this have been handled better from a communication strategy? And is communication something that's best left to a staff role, or is it really a leadership role?
What I would say is I think it should be a leadership role, especially if there's you're giving bad news. I say, and I'd say there's a lot of internal debate on how soon to give information and how much information to give, but it absolutely should have leadership giving that and going through the message and approving that. And, you know, you can oftentimes in a situation like this, you might bring in, you know, a crisis consultant or some other folks that help you with that messages that go through this every day if you haven't been through it. So definitely leadership, and then, you know, and I'm sure at the end of this, we'll all look back and we can learn from it on what could they have done better and what could we learn that we could do better in the future.
Yeah, thank you. When we discuss multiple points of failure, there's a codependent ecosystem just adjacent to the corporations, which includes equity and bond research, audit firms, and others who provide third-party independent reviews on various aspects of corporations. That ecosystem is under quarterly reporting time pressure, has noting staffing issues, and other systemic considerations. Reporting indicates that the CEO of Silicon Valley Bank received a call from Moody's, indicating that Moody's was considering a downgrade to junk for the SVB bonds, which immediately set in motion the failed capital raise for the company. Aside from this call, there doesn't seem to be much indication that the issues, both finance and leadership that we just mentioned, were visible in the company, that were visible in the company's disclosure, were noted publicly by this ecosystem. Recalling that it was Chanos who brought down Enron, short sellers who tripped the crash of 2008, and within the past few weeks, Hindenburg who popped the Adani bubble. We also have at the same time Activision Blizzard settlement of a couple of weeks ago with the SEC, which shows a very keen focus on disclosure. Question to all the panelists: if the depth of report of short sellers are on one end of the spectrum, and that ecosystem I just mentioned is a very big and broad, murky middle, can AI come in on the other end of the spectrum and provide kind of an instantaneous, cheap search for disclosure anomalies? So the impact of AI in the surfacing of stuff that was disclosed but not surfaced. Anyone want to try that?
You know, I would say the risk factors they do nothing but grow in size. We've added lots of risks over the last couple of years, and you know, I would say there's lots of lawyers looking at those all the time when things like this happen. So I think that will be surfaced very, very easily. But I do think just for the average shareholder, that's a lot to read through. And it's basically, you know, you put everything in there that you could possibly think of. So it'll be interesting to see how in-depth that was. And on this next K or Q, how that risk factor will increase in what people are going to say.
Right. So a takeaway on this is disclosure is receiving increased scrutiny from the government, from the courts, and from activists and other stakeholders. Board members must consider uplifting discussion of disclosure in the boardroom, ensuring it's both accurate and consistent among all the channels of communication. So, before we move on to fundamental truth number 2, does anybody have anything to add?
Dana, as the lawyer on the panel, I'm just going to jump in there that I sit in hundreds of board meetings a year, both for private companies and public companies. And one of the reasons that I think NACD is such an effective organization is that you address both communities. And, you know, for the public company boards that I sit in, I don't typically hear a lot of discussion among board members about the right disclosure. I think that they pick an issue and they really drill into it. And I think that I'm hoping that we're going to see a lot of questions about how is cash managed, what is the status of each account that the company maintains within a bank. One of the items on the checklist of our crisis response of the last 6 days, Jane, has been really trying to categorize each account to see whether it benefited from FDIC insurance or if it didn't. If it was, in fact, custodied with a third party, whether there was some way to recover it. And I think there'll be some coverage on that. One of the points that Christine made that I thought was very interesting for those of us who are not CFOs is just how difficult it is for the finance organization to track and manage cash within an ERP system across a set of banks. And I think I'm curious, Christine, if you could share some of that learning with the rest of the audience. And then finally, one of the obvious big takeaways is that in the private company context, I think CEOs and entrepreneurs and CFOs of private companies relied on their venture firms and their experience to set up a single banking relationship and concentrate cash in one place and not have any kind of other cash management or treasury function. That part of the playbook, if you will, of growing a company just wasn't introduced until a company went public. And for public companies that had gone private, that treasury function was often taken away. And I think that we're going to have a lot more focus on treasury. But Christine, I'd love to hear from you on, what is it that it takes for a CFO to manage cash across banks?
Yeah, I would say companies have a lot more bank accounts than you think. I mean, just think if you're just US based and you have, 1 or 2 here in the US, but the minute you start going in other countries in that, you possibly have a local bank in each country. You've got to find a bank that has at least a regional network. And so I'd say when you're looking at banks, you're trying to pick one with a platform that is functional for you and what you can do. But I would say even as a CFO, I mean, I knew all of our banks, but we had a treasurer who looked through it and went through them. But I don't believe he analyzed every single balance sheet of every single bank. I think we're going to see this going forward. I think the audit committee is going to get that, and we're going to look at the banks, the custodial banks, how much is there, how much is insured. I did this with a nonprofit for about an hour and a half yesterday and went through everything they had and where, and trying to decide, did we have cash diversified enough? And then kind of looking, like you said, at whether it's insured or not. And with these sweep accounts that a lot of people learned are actually a pretty good thing. They're actually insured and they roll everything into a $250,000 CD, a whole bunch of them. But and I say when you're hooking the banks into the systems, that changing a bank to something like that can take 9 months. It's a project with IT and finance, and then really getting a good information out of it. So I would say I just think there will be, not unlike anything else, when a crisis happens, we learn from it. There'll be a lot more focus on this. I think people focused on what kind of investments they were making. Let's be really safe. Let's not lose any money. At much less as, what, we're going to go with Silicon Valley Bank. Everybody knows them. That should be fine. So I do think diversification and really is going to be our friend going forward.
Yeah. And I think if I can add something, Christine, I think, you're absolutely right. The treasurers are not equipped to analyze the balance sheets of every bank where they deposit funds. But frankly, some of the equity analysts may not be either, because I don't think really anyone predicted this coming. Up until a week before, probably most analysts still had buy ratings on Silicon Valley Bank. It was only a week before that Moody's started to raise some concerns. And so I don't think it's realistic to push the burden of assessing bank quality onto the shoulders of the treasurer. The reality is that's why the FDIC exists, so that you should not have to do that so long as you keep your balances within the limits. And it may be that the right answer here is for the FDIC to increase the limits for commercial accounts, because practically 250K is not enough for the vast majority of companies to meet payroll. And so there's a logistical issue there. But there's something else you said that really jumped out at me, and it's really struck me, is that we're 48 hours sort of past the denouement of this crisis, and people are already making the same mistake again, which are assuming that these sweep accounts are the right answer. And again, it's people not reading the fine print, because if you read the fine print on the sweep account, all of your money goes to a single custodian. That custodian establishes omnibus accounts and sub accounts at different banks, which may get you increased FDIC insurance coverage if you don't have other balances at those banks. But the problem is you still have a single point of failure, because if that custodial bank goes under, you lose access to all of your money until the resolution process is complete. And this is a little known fact of brokered deposits or sweep deposits, but that structure is in and of itself inherently risky. And so I think it's important, and this is sort of, again, a broader takeaway. It's not just about cash or bank deposits, but educating yourself, reading the fine print, understanding where there's risk and where there isn't, and not just taking at face value what your friend said or what your colleague said or what the latest advertisement said. You really need to think critically and dig in and understand where is there risk and where isn't there risk, and which risks are you willing to take and which ones are you not willing to take.
But who does
Gary,
that?
that's a great question. If I could jump in, what I heard overwhelmingly from CEOs and CFOs for the last 5 days is, Louis, I have lots of risk in my business. I have technology risk, market risk, people risk, but I cannot tolerate 1% risk on my cash deposits. And so I think that's so interesting what you just said about the risk of cash sweep accounts. And I think we should also talk about the other thing that companies need from banks. They need their cash. They also need credit. And we didn't know until yesterday afternoon whether or not SVB would be able to continue to fund the bank lines that they had in place. And we have seen confirmation that they have and are now funding those loans. But I hope that we can pick up and talk about credit later in the conversation. Sorry, Jane.
No, I think you bring up an excellent takeaway, which is a question for every board member is, what risk can we tolerate on our cash and our credit? What are we willing to do? What aren't we willing to do? I think the idea of who shoulders the analysis of it, if it's the audit committee, the board, a treasury function, there may be other ways for smaller companies to outsource expertise in this. Christine, do you have any comments on that? How people can think about it if they don't have a treasury function in-house? Or,
well, I mean, you can go to, you can outsource expertise in just specific treasury area, if that's what you're looking at. I mean, there's folks that would help you do this. You can do the outsourced CFO, and so I think there's plenty of people you can go ask. I do think and I think somebody mentioned it, the PE firms or the VCs might have some people in-house that they can use for all of their portfolio companies, so they don't have to do that. So you can definitely go out and get help. And then it just depends on the size of your company. And, one thing I thought about is a lot of the private equity and VC companies, the CFO may not have been a CFO before. Sometimes they only have a director of finance or a VP of finance. And it seems, given everything going on, that they would benefit themselves by hiring a CFO that has prior experience, a fair amount of it. And it might be really helpful for those founders in that don't have that kind of real world market experience.
yeah. And so we have a takeaway there too, which is human capital management matters. And if it is cost prohibitive to hire somebody like that, you can outsource, you can look at other places. To date, there's been no allegation of illegal behavior among any of the leadership or board members, yet DOJ and SEC investigations have been announced, clawbacks have been discussed, and the class action lawsuits have begun. So turning to our lawyer, what can board members, aside from SVP, just a general question, what can board members expect in terms of time spent, reputational risk, duration of the process in these types of lawsuits?
Great question. And I think most board members that join a public company will benefit without having to do any work on it from a D&O insurance policy, which is usually robust and designed to match the size of the company's equity value. They also will benefit from a D&O indemnification agreement, which not only reimburses you, but in fact advances expenses as and when you incur them. And finally, usually a very top quality law firm who will take a lawsuit and defend it soup to nuts such that you really can outsource as a director the risk to the insurance policy and the lawyers that are going to come and handle the matter. Now, in terms of time spent and reputational risk, there's, once that Google hit appears with your name on it, it's very upsetting. And the number of people that clients I work with that just are so upset by that. And anytime you ever do a Google search on your name, it's going to pop up. So that's very upsetting for people. That being said, it is, become for many years part and parcel of being a public company director, that you will likely at some point in the life cycle of a company get sued. And so, Christine, I think might have some valuable insights to share on this point. In terms of time spent, I think a public company lawsuit, you can generally rely on the lawyers to handle it, but I think there's an unquantifiable amount of time and stress that you're really going to be living with and sleeping with as time goes on that suit. You're personally named and so forth. Now, if you're a private company, I think directors really don't spend enough time thinking about how much insurance they have, what's the quality of counsel that the insurers will appoint, what are the caps, what are the deductibles, and I think they're actually a lot riskier because they're not handled in the same fashion. And I think the claims are often a lot more personal. And so I would encourage directors out there to, before they accept an appointment, to really consider the coverage that they have, as well as the indemnification agreement. Make sure that it in fact advances costs as they're incurred, not just reimburses them at some later point, which could be years later.
So
sorry, Jane, I took too much.
Thank you for that. And that's a great takeaway on D&O insurance. We got asked in the questions that came in before, and we'd also thought about it. I know in the context of an M&A situation, during the pendency of the transaction, you negotiate a tail on your D&O, typically 6 years. Is there a tail on D&O insurance when the government has taken over your company? What happens? Who negotiates it? Who's going to provide the D&O insurance?
That is a great question, and the devil is in the details, Jane. That's all I'll say.
Okay. Christine, do you have anything that you want to express about shareholder lawsuits, things like that?
No, what I would say is and this is again in the public company area more, as you're doing M&A, buying or selling or recapitalizing debt or anything, you really need to be listening to the lawyers. You need to be following the right procedures and looking, doing all the things that you need to do, for your duty of care and that and business judgment rule through the company and document it. You really need to focus on that. And, I think people do more and more, because if you come out and the stock drops, it could happen. And what's going to protect you is going to be, as they look back at the diligence you did, they're going to discover that.
Thank you. Anybody have anything else to add on that? If not, I'd like to broaden the discussion to outside Silicon Valley, the repercussions of this, and how it might hit different companies in different ways. So, Christine, a very specific question. Now that the immediate crisis is over, or maybe we're in the middle of it, but we've been through at least a week, what do boards need to do?
Well, I think what I see now is we were getting daily updates from boards that had any exposure, or, luckily the ones that didn't, we got an email that, they didn't. I think part of it is we had to look immediately as to, do we have any public filings that we have to do? Do we do an 8K just to have air cover to talk to investors saying, I have a small risk or I don't. Pending SEC filings, what you're going to see is the auditors are obviously going to ask a whole lot more questions about this than they did a week ago. And I've seen just on pending filings, they're coming in, even though the monies are protected, they want to start looking at it more, understanding why you believe that and where it is. So I think that's sort of another effect that's coming on board. And again, boards need to go in and look at where your cash is, what bank, how much, the risk, everything associated with that, and start making decisions that I'm sure they weren't talking about in detail 2 weeks ago.
Thank you.
Great point, Christine. And I want to jump in there and talk about those 8Ks. And we have a survey
just about to throw it over to
available.
you, Louis.
If anyone is interested, reach out to me and I'll be happy to share it. But companies on Friday night and through the weekend were filing 8Ks talking about their exposure to these banks for their cash. But really, the mandatory filings, which are triggered 4 business days later after the trigger, relate to whether or not a bank facility was breached and whether there was an event of default, whether there's a cross event of default across other facilities. And one of the very interesting things that we learned about these bank facilities is that they often required you to not only maintain financial covenants, but maintain cash in the bank. And so as people were stampeding out of some of these failed banks, they violated the written covenant, which said you had to maintain at least X of cash in the bank. And so those facilities are in default. Now, we wondered until yesterday afternoon whether the failed banks were also in default because they were no longer responding to requests to draw down cash out of the facilities. And so flipping back the discussion about risk management is do you have access to cash? Do you have access to credit? And these banks were performing a very key function in the innovation economy by making debt available on a term loan basis, on a revolving loan basis. They were financing working capital. They were financing accounts receivable. In some cases, they were almost factoring loans. And so as a business, we learned that your ongoing access to cash at any given time during the month, your access to credit is a critical risk item to manage. And, while I think over the weekend we were all worried about cash, today, it's Wednesday, March 15, we are going through our clients' banking facilities and looking to see which credit facilities are still good and which need to get refinanced or amended or waived, and how to handle what we think is coming down the road next. Jane?
Thank you. So Gary, I'd like to ask you kind of the same question with a different flavor. We've all learned the term HTM assets, held to maturity assets, on bank balance sheets in the last few days. Is there an analog to corporate assets which are subject to periodic impairment testing?
Well, it is interesting, Jane, because you're right. This was an area of bank balance sheets that most people didn't focus on so much, in part because interest rates have been so stable for so long. And frankly, when the pandemic arrived and the Fed cut rates very quickly, banks made profit from securities that were categorized that way. So I think this is, everything old is new again, but when these cycles happen over multiple decades, it's often easy to forget what the last tightening cycle looked like. In terms of other industries, I mean, everyone can be subject to different types of exposure, and you see industries write off assets all sorts of times, right? Someone buys a popular media property, and that media property is no longer it goes out of fashion, and so they take a write down on the acquisition, they move on. The difference with banks is that banks are required to keep a certain amount of equity capital for regulatory purposes. So if a bank takes a loss, they have to go replenish that capital. And that's where Silicon Valley Bank went hand in hand saying, I need $1.8 billion yesterday. Whereas if I operate in an unregulated industry and I take a loss, it hurts my shareholders, but I live to see another day and I move on, and I have flexibility over when I raise capital. So I think it's maybe an important distinction.
Let me just focus a little more. You do impairment testing on an as-needed basis or once a year. If you're involved in a divestiture, you expect to get X dollars to pay down Y debt to delever. If you're involved in any type of merger or acquisition, your values are out there. They may be embedded in your strategic projections, your financial projections, what's going on. Has anything with this situation changed that? Is
Well,
there likely to be
yeah.
less access to capital, tightening, higher costs that impact asset values outside of the normal cycle?
Yeah, I mean, I think there may even be legislative changes because, the banks don't have to take mark to market on this, and that's sort of a loophole. So I think where it's going to get interesting are sort of what other legislative changes might there be, or what other differences might there be in how people manage their assets, right? I mean, a bank fundamentally borrows short and lends long. And 99.9 days out of 100, that works really well. And occasionally it doesn't. And when it doesn't, the consequences can be catastrophic. And I think this sort of all comes back to the business model. And this is why I don't see really big contagion risk in the banking sector. Most banks are very well capitalized. Most banks have a good diversity of funding sources and a good diversity of customers. The issues at Silicon Valley Bank were relatively unique and I think fairly contained as well. I can't think of another bank that has 95% of its deposits uninsured. And again, if we go back to that sort of forest fire analogy, most forests are healthy and the wood is not dry. But in this case, there was strong incentive for people to pull their money once they perceived risk. So I think I think if there's sort of a fundamental lesson here, you could blame bank management for poor risk management and poor balance sheet management. The reality is, if you want to be fair to SVB's management, people's expectations of the yield curve are always wrong. In fact, the one thing that is that however the experts are predicting the yield curve will move, they're wrong. They're almost always wrong. And they may be wrong now when they think that the Fed won't tighten. Maybe the Fed will continue to tighten because inflation is still, in my view, completely out of control. But those are, I think, sort of some of the key lessons is that a bank is not at risk. If a bank had all of its deposits, if all depositors at a bank were fully insured, there would be no reason for a bank run to ever occur because people would know they're always going to get their money back. And so they don't need to worry about risk. And that's a broader lesson. As long as
they become a utility, they basically
exactly. It's only right. The risk here existed because so many people were uninsured to such a degree in such an existential way.
Yeah. So let's, I want to wrap it up so that we can get to Q&A. And I'm going to ask each of you, if you were to pose one question that board members should consider asking their boards, what would that be? And Christine, I'll start with you.
Well, I guess I would liken a little bit to the supply chain issues we had, sole supplier and things like that you don't want. We should do an exercise like who are your sole suppliers just on your finance side? Is it your bank, your law firm, your insurance company, your D&O? What if that company went away tomorrow? What would you do? And I think that's what people did all weekend is, what if your money goes away? What are you going to do? Some people were writing out furlough notices because they didn't anticipate being able to make payroll. So I think you need to kind of look at all of your vendors, I guess you'd say. I mean, you could say the same thing on a customer, harder to change quickly, but what would you do and have at least thought through the exercise? Now, unlike cyber, if you're hacked, what do you do? What kind of crisis mitigation do you follow?
Thank you. Gary or Louis? One question for a board?
I thought Christine's answer was so excellent. I don't have very much to add other than, do we have the right expertise on the board? Do we have a financial expert on the board? Public companies all do. A lot of private companies have very small boards that tend to be pretty insular. So I think sort of diversifying those boards, bringing in some independent directors, it doesn't assure success, but it certainly could improve it.
Thank you.
Yeah, I think the obvious one is, do you have a cash management policy? And I think the other one is, do you have a crisis management response playbook? And I think it was in vogue maybe 10 years ago to go do that. And I think those have gotten very dusty. The people who put them together are gone. They were forgotten. And I think it's time to dust those off and do, you know, one thing that we do with some of our public company boards, and I wish we did them with more of our private company boards, is what I'll call desktop exercises, where we kind of have we set aside an hour of a meeting and we do a hypothetical which is invented, and we run through the responses, and I think those are so useful, Jane.
So a desktop exercise focused on, if any of your primary vendors, lawyers, accountants, whatever, cease to exist, what would you do? Where would you go? What's plan B? So another great takeaway. Before we open to audience Q&A, a lot of you had submitted questions beforehand. I see that there's over 60 questions in the Q&A queue right now. And a few of you asked specific questions on the competencies of the Silicon Valley Bank board and have alluded to certain statements and news articles pointing to the diversity of the board, and was being a woke board a contributing factor. Board diversity has been shown in several academic studies to result in outperformance on financial, cultural, and operational metrics, indicating that overall qualifications, capabilities, and contributions are enhanced by diversifying boards. It's disappointing, it's damaging that the composition of this board in terms of diversity has become a focal point in this conversation among some people. So I'd like to ask Marcel if he can give us some questions from the audience.
Yeah, thanks so much, Jane, and thanks everyone for submitting. As mentioned, there are quite a number. I'll try to group there's a number of questions that came in about the role of the auditor here. And again, we're not looking to assign blame or make prognostications about what happened or not, but any question, I suppose, about the role of the auditor, how boards should think about engaging their auditor and perhaps a little more actively to help ensure this doesn't happen to your organization.
Yeah, I'm happy to take that. I would say the auditors will have enhanced their procedures. They probably did that on Monday, going forward on this, looking into that. So there's no question. I think I read an article is where it wasn't in the CAMs, which is what kind of the look forward. What do you worry about with this company? A lot of times that's sort of revenue or M&A, and it wasn't in there. So obviously, there'll be a lot of questions asked there, and new process and all that will come from that. And to be honest, the auditors will be doing more about that, but it'll be an interesting one that again be investigated on that side too.
That's great, thank you. Louis, there was a question here that you offered to answer. Do you anticipate new rules on risk reporting to arise from this crisis?
Yeah, I wanted to get Gary in on that question as well. I do believe that there are regulatory changes that could help us navigate the crisis as we go forward and prevent another one, regarding ratios and how treasury bills are reported and so forth. But Gary, I think this is more your area of expertise.
Well, it's timely, Louis. I was at a discussion last night, hosted American Banker, and Raj Cohen, who's arguably the most preeminent regulatory attorney, spoke. And his takeaway was that if you think back to the financial crisis, all of the regulation that was passed following the financial crisis focused on risk and capital. And his view was that going forward, the next wave of legislation will focus on liquidity, which is really something that regulators haven't spent nearly as much time thinking about. So I think it's an interesting shift.
All right, Jane or Christine, anything you'd like to add there? If not, Gary, perhaps I'll stay with you. There was a comment which leads to a question. Are we confusing capital risk with liquidity risk, right? Clearly liquidity risk in the case of SVB was real, much of it based on public trust. Can you help us understand if there is real capital risk? In other words, are net assets smaller than liabilities?
Yeah, I think, thank you. It's a great question. I actually my personal view is that the banking sector is quite healthy. Capital ratios are much better than they were heading into the financial crisis. I think a lot of the regulation helped with that. I think management teams have generally been much more careful. One of the capital risks has now been addressed by the Fed, which was this idea that if I bought 2-year treasuries or 5-year treasuries and I need to use those as collateral, I can exchange those at the Fed for 100 cents on the dollar. It's effectively a sort of, we're back to zero interest rate policy. But I think that's a very effective backstop because it ought to satisfy investors and depositors' concerns about liquidity or capital issues or potential capital issues that could have been caused by the steep run up in interest rates. So I think that's one area. I mean, the other thing we haven't talked about is the typical capital issues that you might have at a bank, like what happens with commercial real estate. And so that's much more bank by bank, right? That's more of traditional looking at a bank, understanding its loan portfolio, where is their risk of loss or default, and banks provision for this. And so that's, generally relatively transparent. So I'm, stepping back, despite all the market volatility, I don't see major capital risks across the banking sector. I think this one was fairly unique, and ultimately is more of a liquidity risk. The liquidity risk exists for every bank every day, but rarely is there really much basis for it, and so people stay happy and stay put.
Thanks, Gary. We still have many more questions we probably won't get to. We'll try to perhaps respond to some of them after the fact. We are coming up on the end of the hour. One last question that I might pose to each of you, but Christine, perhaps I'll start with you, and we'll allow you to answer either side of the question. The question is, what advice do you have, or what question do you think a bank board director, financial services director should ask when they walk into their next board meeting? But perhaps we allowed you to either respond to that or to any director that walks into their next boardroom. We've talked about a number of takeaways, but what's top of mind for you, Christine?
Well, I mean, based on this, I would walk in and say, what are we going to learn from this crisis? What are we doing, and what are we going to learn? And what other downstream risk from Silicon Valley Bank, from the interest rate hikes, what other downstream risks are we not thinking about? And really try to put some thought into that.
Thanks, Christine. Louis, perhaps I'll turn to you next on that same question.
Could you repeat the question, Marcel?
What question would you suggest that directors, whether on a financial services or bank board or any board for that matter, ask when they step foot in their next meeting?
Gosh, so many questions, Marcel. I don't think I could limit it to one.
All right. Well, we'll have the next webcast on that then. Gary?
I think I would ask, I would say to the other board members, you've all read the news, you've all followed this situation very closely. What story is not being told? What questions have not been asked, right? I think, a week from now, everyone will be able to go into a board meeting and provide a relatively cogent explanation of what happened. And there's been very broad press coverage, but which other stories haven't been told? And which angles haven't been covered, and what else should we be thinking about? Because the biggest risks to a company are not the ones that you can see and identify, they're the ones that you don't anticipate. And for a lot of people, liquidity risk around their cash in the bank was not high on their list of risks that they had identified. So it's almost an exercise in creativity and trying to uncover what we may not have been thinking about.
Marcel, I'm going to take my pass back and answer the question. I think a critical area is to challenge assumptions. And just this morning, Marcel, I woke up and saw that the treasury markets are snarled, according to the Wall Street Journal. And trades, instead of getting closed in seconds, are not getting matched for minutes. And in fact, I saw one report that it took over an hour to process a trade. And so what I'm saying is that we all assume that there's immediate liquidity in the treasury markets. What if there isn't? What are the other assumptions that everything is based upon? And just that interest rates would stay low was one that everyone was assuming for so much time. Now it seems Captain Obvious. But what are the other assumptions that all of our house of cards is built on, Marcel. Sorry, back to you.
Thanks, Louis. And Jane, you did an outstanding job moderating today's discussion. So thank you. I want to give you a chance to say any final remarks before we wrap.
Well, you know, I thank you for that, Marcel. Thank you to all the people who participated. I'm astonished how quickly these experts really lent their time and dedication to this. So thank you to Gary, Louis, and Christine. And I'd just also say, we're all learning here. It's a steep learning curve, but hopefully we can bring back some actionable plans to our boards. So thank you very much.
That's wonderful. Well, as you said, we're all learning. We want to encourage everyone on this webinar to stay in touch with NACD. We're going to continue to look at this and to really take advantage of your local NACD chapters as well. I know that the NACD Northern California chapter is hosting a session they've already planned on Tuesday, March 28th, that is going to build on today's discussion. That session is titled Silicon Valley Bank Failure, What Does It Mean for Director Priorities? A great theme for the NACD. Again, please join me in thanking Christine, Louis, Gary, and Jane. Recording of today's session will be available shortly. We will send that out by email. We welcome your feedback on this. There were great questions that came in. We're sorry we couldn't get to all of them. Perhaps we'll try to respond to some of them after the fact. Continue this conversation as we learn together. And so until next time, on behalf of NACD and our speakers today, thank you for participating. Have a wonderful rest of the week.